Bringing in Chakri Lokapriya, Managing Director at TCG Asset Management. He's joining us on the show right now. Chakri, thanks very much for accommodating this very short notice request. I want to start off first with the deal that's happened within the consumption space now. Amazon is clearly extremely positive on the India story. I mean, even while we question consumption here, they're probably seeing something we're not. This is their third investment in physical retail here in India. What would you make out of it? Probably, the fact that if they're seeing something coming out of this, it should not be that bad, and probably even retail investors can start looking at nibbling into some of these even expensive consumption stocks.
Good morning, and thanks for having me on the show. I think Amazon's entry into India, or rather expansion into India, is a function of the buying up various building blocks which is necessary for them to compete effectively in any given country. And they have done that time and over again in different countries. And so from that perspective, yes, the acquisition clearly demonstrates an interest in India, but I wouldn't extrapolate saying that and therefore it is time to buy, because they're buying enabling companies which will help them do their business better in India.
Okay. All right.
Okay, Chakri, good morning. Having said that, are you buying either enabling companies or other companies? You've largely been a bull on India the last few days because of the volatility surrounding the expectations of stimulus and dashing the hopes, and then reigniting those hopes have led to significant volatility. Now seems to be a clear downtrend. Are you buying here, or are you as bullish as you would be, preferring to sit on cash?
Good morning. As the budget approached, we were very bullish, but post-budget and the introduction of the FPI taxes, the taxes on AIFs, as well as a kind of a reluctance, or rather delay in responding to corporate requirements, is something which is deeply troubling for the market participants. I mean, look at various government companies, BHEL, SAIL, MTNL, all these companies are trading at decade lows or 15-year lows. And the last thing you would want is a government economic advisor telling corporate India how to run companies. Worldwide, central banks and governments and companies listen to companies' needs because they are the drivers of growth. They are the creators of jobs. And here we have, and so when there is that lack of communication and lack of receptiveness, I think that has never been a good news for markets around the world, and it's manifesting itself in India. And so as long as there is no communication, or rather poor communication, I think these markets will drift lower.
I just may sound like a contrarian, but even if, for that matter, we do see a recovery from here without any stimulus, wouldn't that then be a more real recovery without any short-term shots in the arm, more sustainable recovery, because you've reached grassroots levels, and from there you've actually started to pick up on all variables without any external or stimulus support?
That's a good point, but one has to look back at what caused the economic downturn, or rather the slowdown, which is in many cases, for instance, power companies. They still have to, account receivables are pending from the government. Telecom industry, huge amount of debt because of a TRI's regulation saying mandating lowest tariffs in the world and highest spectrum prices. You look at media broadcasting companies. They have now the lowest broadcasting rates in the world. So that has led, or rather increased, the the corporate stress, the balance sheet stress. And in any business, and that's the problem with Indian government too, when your revenue that is lesser than your expenses, then there is a problem. And then if you try to manage the situation by increasing taxes rather than increasing demand, then it's not such a great thing. I think that is what has happened. And then over and above that, further increase of taxes. Today, an FPI who comes into India, a very important source of capital, more than half of all capital which comes from FPI. And if you tax them at punitive tax rates, whereas advanced countries do not do that, then capital will flow elsewhere.
You know, I take your point, but when you have, industry leaders, I'm talking from the auto space, you had Mr. R.C. Bhargava and a few other within the auto pack itself, which is suffering a whole lot, saying that the industry needs to look at its own shortcomings and we can't expect the government to sit and cut taxes for us. That probably lays it out for you.
Well, from that perspective, it was the government or government agencies which introduced insurance, 3 years insurance on companies. A buyer of an auto. When you buy a bike or a car, then you insure it for the first year. But why should one introduce and impose a 3-year insurance to be made upfront? Who introduced it? It's the government who did that. And then you look at the registration taxes, road registration taxes has gone up manifold, and now there's a proposal to hold it back. So when the rules of the games are changed, and the input tax credit, there is a huge amount of delay in the repayment of this. So all these are factors which are not caused by the industry, but rather these are the cogs in the system which has contributed to the current downturn.
Chakri, not being bullish is one thing, being bearish is quite another. Are you bearish?
Magically tomorrow, if we have some policy announcements or rather policy measures, the reversal of FPI taxes, we would be turning really bullish. On the absence of which, and it's been a month and a half, then I think there is no reason to change your stance, but to continue to be cautious.
So it's not an economic call, it's a tax-linked call, your bullishness or bearishness?
Tax is one of the most important things because tax reduces flows goes into companies, and that leads to private capex creation, which converts into jobs, which creates into income. So while the government is focused on just the tax issue, the chain of linkages in that of how important capital is. Now, I think it serves well for everybody to remember that equity is risk capital. Risk capital, therefore, is taxed at the lowest tax rate around the world. One cannot tax it at the same level of debt because debt is seemingly assured a fixed interest rate, if a fairly good credit allows a repayment of principal, whereas equity is risk capital, which is therefore taxed at a very, very low tax rate, including the developed economies. By taxing it at far higher rates, clearly then we're choking off an important source of contribution for creation of capital expenditures by companies.
All right, Chakri, great having you today and appreciate you taking out the time.
Thank you.
Thank you so much.